Hi, and welcome to Financial Thought Exchange from the CFA Institute Research Foundation. I'm Larry Siegel, your host today, and our very distinguished guest is David Booth, who founded or co-founded Dimensional Fund Advisors a long time ago. And it is one of the most successful investment management firms in history, and it is certainly the first to bring index fund and index plus investing to the common people, to retail investors. 1982 was the founding year. Is that correct?
Well, we started the firm in 81, but we didn't actually start investing the money till right at the end of 81, beginning of 82.
Well, that was an exciting time for those of us who were at the University of Chicago. We had Nobel Prize winners, future Nobel Prize winners, running around in the hallway handing out papers that we thought were just pieces of paper that we were supposed to read for class, but turned out they were from the greatest financial thinkers of all time. Can you tell me a little about that period?
Yeah, it was a period that was really a revolution in finance, a total paradigm shift and thinking about investing. And it was brought about largely by data and computers. Before 1963, the data weren't there to examine much of anything, and computers weren't big enough to process big data. But that all changed in the 60s, and it was there was just a hotbed of academic research. Eugene Fama, my mentor, says it was like shooting fish in a barrel coming out with new papers because nobody had ever been able to process the data. Or to do something like a simple linear regression, on an HP 12C or something, that's fraught with problems. But
That's what I remember, is that at the Center for Research and Security Prices, which is a University of Chicago center, and it's commonly called CRISP, everyone associated with it was tremendously excited about this new access to data and new access to machines that could process the data efficiently. But what were by the way, the head of CRISP at the time that I got there was Roger Ibbotson, who
oh, okay.
we'll get to in a minute, as a central figure in this revolution, and certainly for me, because I worked for him for 15 years. But what was so exciting about having access to data on the securities in the market?
Well, you could test out hypotheses, that people were claiming or asserting. You know, money managers could claim almost anything if you didn't have any, evidence to support the claims. And what kept coming out again and again was that the market does a pretty good job of sorting through prices. For example, remember when the first study by Laurie and Fisher using the data showed that the compound return on stocks was about 9.3% per year. People were shocked.
Because it was
Shocked by
so
it.
high, or they just didn't know, they had
Just
no
had no
idea?
idea, right?
Had no idea.
And trust departments, at institutions hadn't achieved anywhere near that, and so it created a lot of excitement. Some of these professors early on, like Jensen and Fama and so forth, really took a lot of flack for saying, "Look, it doesn't look like managers are adding any value here," and everybody just asserted, "Oh, that's crazy. Here we know, everybody can beat the market. We know that." And go, "That can't possibly be true."
Well, mathematically, not everybody can
Yeah,
be better than average,
right.
but unless they live in Lake Wobegon. But somebody can. And I think that what the managers were claiming was that the idiots out there lose money so we can make money because we're not idiots. And it turned out it wasn't that easy. And the track record of professional managers was also below the market. What was your own role in this? You must have been a PhD student, or maybe an
That was
undergraduate at
yeah,
the time.
yeah. I started in the fall of '69. I was in the PhD program. Took my first course from Eugene Fama, first finance course. And in that class was Roger Ibbotson, among other luminaries.
As a
And,
student.
as a student,
I
yeah,
see. Okay.
and that's where I kind of learned the principles of finance. My second year, I worked, as did Roger, as a research assistant and teaching assistant for Gene Fama. Back in those days, I finally decided I didn't want to be a professor, and Gene Fama then called up Mac McCown out of Wells Fargo, who was
Mhm.
starting the first index-linked type strategy, and I decided that's what I wanted to do, was apply the ideas. I didn't think that I would be my comparative advantage wasn't thinking of the next great idea, it was applying the science that had been developed. Going back to data, you can't have a science without hypotheses and testing, empirical
Right.
work, you know? So now with all these studies, finance emerged as what I think of as a science.
Well, I think that's right, and the fact that a host of Nobel Prizes has emerged from basically the finance faculty at a number of great universities shows that somebody else thinks it's a science too.
Right.
Let's move forward to the time. I am curious of what you did for Mac McClellan at Wells Fargo, but I figure you'll weave that into the story. When I came to know a little about finance, and especially Roger Ibbotson, who you mentioned was in your class as a student, by the time I'm a little younger than you, by the time I got there, he was a professor, and he did to me what Gene Fama did to you, which was have me do all the legwork while he analyzed the markets in his unique way. So at the time I first ran into you, you were talking about setting up a firm to implement some of the theories that you had been working on. Can you give me some color on that period?
Yeah, well, I even start I was kind of an outgrowth of that first experience at Wells Fargo. You know, um, they were the first people to really come up with, let's call them passive strategies. Mac had gotten the trust department to come out with an S&P 500 index fund, which was
Hmm.
revolutionary at the time. And then I worked in a different group, and the two chief consultants that Mac used on that were Black and Scholes, Fisher Black and Myron Scholes, who
I've
worked,
heard of them.
yeah, and working with Mac on the index projects, they ended up developing this little thing, Black-Scholes option pricing model. So these were wild times, new ideas springing up everywhere. It was incredibly exciting. Fast forward 10 years, we came up with the idea to start Dimensional. Back in 1981, big institutions weren't holding stocks of smaller companies in any meaningful way because the way they access stocks were through actively managed portfolios, and professional money managers can't create a big enough firm to be economic if all you do is pick stocks of small companies. There's not enough of them to go around. So what came up through was a portfolio solution. Look, we'll have a basket of small companies, and we call it. I mean, it's a passive strategy in the sense that we don't try to outguess the market. But one of the things that we had learned by that time was that flexibility has economic value. That's an implication of the Black-Scholes-Merton option pricing models. Is flexibility has value. And we looked at index funds. I go, indexing is pretty good, but it's not great because it's so mechanical, so rigid. And, and our belief is if people that use a little bit of judgment and have some flexibility can do better than people who have rigid decision making. That's how we started the firm.
Why small caps? You were known at the beginning as a small cap index fund. However, there was a lot of research going around showing that small caps did better than other stocks. Was that research what motivated you to build a small cap index fund, and how has that strategy held up over the years?
Well, it's what motivated it was this idea that institutional investors ought to have stocks of large and small stocks in a well diversified portfolio, and they're only holding large cap. So that was our sales pitch. Large and small. Well, you don't have small now. We'll give you access to small companies. and people loved the idea. And we had our first commitments for clients before we had the data. Now, then Rolf Bonds, it turns out, had done his PhD dissertation on exactly what we were looking at, the relation between the performance of small company stocks versus large cap stocks.
I
And
remember that. And
yeah,
it was kind of wild because you said that people were angry at the efficient market professors. By the time that I was an advanced student and the Rolf Bonds published his dissertation, people were angry at him because he was
yeah, right.
saying that the market wasn't efficient.
Yeah. No,
Things
that was the
change.
first.
Yeah, right. Yeah.
It was the first kind of really good, robust study that argued against the capital asset pricing model, which is a great model. I think they probably still teach it at schools because it's so easy to explain. It only had one drawback. It never seemed to explain differences in average returns. And
That's a starting point.
that's a good starting point.
Right.
Yeah.
Yeah.
And so we thought of a small cap in my limited thinking, thought of small cap as being kind of a different dimension. Small stocks not only behave differently, they do it in a kind of a systematic way. So you can think of it as being a different dimension. So we were inadvertently walked in. We were kind of the first factor investors
Yeah, you were the first
without even
investor.
using the term. But we had, and then once we did get the data, frequently and talking to people, people would say, well, how have they done small stocks? I go, well, I'm not going to tell you. They go, why? So you believe the story, beliefs, are stronger than data every day of the week. So
And getting people to commit funds, yes. But the reason I might not have told them is that small stocks have done so spectacularly well that they've gone from cheap to expensive, and you couldn't really expect them to do it again. Uh,
yeah,
that's my concern with large caps now is that, yeah, sure, the stocks have returned over 9% a year compounded since the data began to be collected. But when the data began to be collected, stocks were selling for something like 9 or 10 times earnings, and now they're selling for more than 20.
yeah.
So maybe maybe we can't expect the same performance again. What do you think?
Well, just kind of complete the story because
Yeah, I was.
it's this whole notion of indexing is one way to approach the market if you don't think you can pick stocks, but it has the drawback of being rather mechanical. For example, if you want to track an index exactly, you have to trade at the closing price. And particularly on days when new stocks come into an index, all the people tracking that index, they all have to add that stock at today's closing price. So we said, hey, look, part of the judgment we'll use is we won't do that. We'll trade throughout the day and avoid the rush at the end of the day. There's a huge rush for the door. It's probably not a good idea to trade at exactly the same time everybody else is trading.
And especially if they're all buying or all selling.
All buying or stuff. So we're not gonna do that. And people will say, well, gosh, like Myron Scholes goes, well, I'm skeptical here. And we go, well, hey, we're all skeptical, but that's what we're going to do is we're going to try to sit out there and understand market mechanisms better and add value in a variety of little, you know,
Mhm.
small ways here and there, trading, develop some skill in that and securities lending, there's a variety of things you can do to add value, over indexing. We're like other professional managers. We claim we can beat index funds, but we don't do it with a um, superior selection. We do it with understanding market mechanisms and using this history of research to structure portfolios better that we think than are available through public indices.
Well, I just mentioned a fellow named Rex Sinkfield, who was, or maybe is, your business partner for the last half century.
Yeah, 44 years. Yeah,
Not quite. It's 44 years. And when I mentioned to my wife that we've been married for the the most of the last half century, she doesn't like it either. Uh, who is Rex Sinkfield, and why did you hook up with him as opposed to one of the other luminaries that was in your circle?
Well, it does tie back into Roger Ibbotson a bit as well.
Who's he?
In the days
Yeah,
when Roger
give
and
me
I were,
give me some color. Tell me about the
yeah.
circle.
Well, Fama taught this introductory course. He doesn't do it anymore, but that year that Roger and I worked for him, he taught an introductory MBA course in
Right.
in finance, and Rex was one of the students. So the class would meet on Monday and Wednesday, and on Friday they had an optional Q&A session that Roger and I, and also Stan Smith, third PhD student, we would run those Q&A sessions. Well, not too many people showed up. Rex showed up every year, every week, and
Mhm.
always asked the tough questions. And we all kind of became friends. And he and Roger became very close friends. And eventually they created really a landmark study for several years. They published, tables of data on the performance of stocks and bonds, bills, and inflation.
Well, that this stocks, bonds, bills, and inflation work has is now seems to be falling into the lap of the Research Foundation, which is going to publish the Century Edition in 2026. Uh,
Well, that's
they
great.
didn't start collecting data in 1926. Not sure they were even born, but the data begin in 1926, and causing some humor among people who expected Roger Ibbotson to be 20 or 30 years older than he is. And so 2026 we'll have 100 years of data, and we're going to make a book out of it.
Well, I think that's really important. See, when CRISP, as we talked about, came out with the original uh, data in 1963, well, it turns out nobody followed up on that and updated the data. And so by I don't know when Roger and Rex started, early 70s,
They really
uh,
said, yeah.
it was really updating the original work and expanding it a bit as well. So it was really an important work, not only interesting, but really fundamentally. How can you, if you don't have the data, how can you make very sophisticated arguments?
Well, you also have to have a theory. In the 1960 Fisher and Laurie book, they didn't pull out from the data the fundamental insight that Ibbotson and Sinkfield got, which was that you can figure out the risk premiums in the market as the difference between the returns of various assets. For example, the equity risk premium is stocks minus bonds. And today we tend to use the term equity risk premium to mean the expected or forward-looking premium that an investor can expect to get. But at the time, Roger and Rex really meant the premium that had been achieved over some historical period, and that's where they got the, I guess, 9.3.
Well, and so Rex, after he got his MBA, went to work at American National in Chicago, which was a sleepy little bank on the north side. And he ended up being the head of the trust department and turned it into one of the 25 largest trust departments in the country. And based
That's what
on
he did. Yeah.
the S&P 500 index fund. And so we came across this idea of a small cap fund. And we called it an index fund at first, but you can't call it an index fund if you outperform it by 150 basis points here. Anyway, Rick's got wind of what we were doing and called me up, and I chatted with him. I said, "Gosh, I mean, you and I are working for the same cause here. Why don't we merge our efforts?" And that's how we came together to start Dimensional.
Well, I remember Rex. I met him before I met you, and I said, "What's dimensional?" And he said, "Well, we're investing in a particular segment of the market that's been shown using data studies to be superior. So it's not active, it's not passive, it's dimensional." And I thought that was very cute. And I didn't know that it would become the dominant way of quantitative investing for the next 40 some years. But basically, you were the first factor investor. Now everybody's a factor investor.
Well, no, and like I say, the big thrill of all this is it worked. I mean, here
Yeah,
again, if you'd invest in $1 in the Russell 2000 the same time we started our fund, you'd have almost twice as much money invested in our fund today as if then had you invested in the index.
Yeah,
I think
sure.
that's goes back to strong academic principles. Flexibility has value, and then along the way you have the multi-factor theory, of Bob Merton, which is supported then by two of our directors, Eugene Fama and Ken French, that developed the empirical multi-factor model, which led then to the creation of our value strategies. So we have a solid academic basis, both for the reasons we structure portfolios the way we do and the way we implement. And even if people copy the way we structure portfolios, they can't copy the way we implement them.
Well, they also would have a hard time copying the way that you use academics
Right.
because there aren't enough academics to go around. You've already hired them all. Tell me what those relationships are good for and a little bit about some of the people, if you care to.
It actually ties into how I met you with my recollection. So we decided at that time, our first small cap portfolio would have over 300 names of small companies. So we figured we needed to commingle it in, and we decided on a mutual fund format.
Yeah.
So one day we were in Mama's office actually, and meeting with our lawyers, and they said, you need to have an independent board of directors for a mutual fund. I said, no kidding. So Rex and I, we were in Fama's office. We just walked across the midway to the faculty building, or the building where the faculty offices were. And we went into Merton Miller's office. Said, Merton, we need an independent director. Merton said, okay.
Sure.
And then we walked down the hall. And Merton Miller was coming down the other way. He was on his way to lunch. And I said, hey, Myron, we need independent director. He goes, well, how much are we going to get paid? And I said, well, it turns out we don't have any money. And even if
there could not be a more perfect illustration of the difference between Myron Scholes and Merton Miller.
Yeah, that's right. He goes, well, I can imitate Myron even better than Myron does. Wow, how much are we going to get paid? And so, I said, even if we did have money, you're supposed to be an independent director. We can't pay you. But the mutual fund, if it gets off the ground, there'll be director's fees. He goes, oh, okay. And he was really nice about it. I'm not trying to suggest he was anything other than terrific.
Nor am I. Just that just seems so much in keeping with what I know about those two guys. Merton Miller was the most easygoing finance professor about to win a Nobel Prize that I ever met.
Yeah, he may have been among other professors, he may have been the favorite because he had such a great sense of humor.
The nicest. Well. Yeah, that's right. Yeah.
Following that, just the same day, I think that afternoon, we went down to Ibbotson Associates offices and invited Roger to be an independent director. And I think that's when I met you that same day.
That's right. Yeah.
And because I remember the discussion, Roger just said, are you selling that this is some kind of alpha? I said, no, we're selling it as diversification. Our clients aren't invested in small cap, and they know that it makes a lot of sense, economic sense, to have both large and small. And that's what our pitch is. If it turns out they have higher returns, that's, the data suggests that there's a good chance they'll have higher returns, but that's not the sales pitch.
That's a very modest sales pitch. And it turns out that was exactly right, because everybody else was coming in and saying, we're delivering alpha, but obviously they couldn't all do it because they're all betting against each other, and everybody can't be better than average. But yeah.
Well, and it turned out to be really important as well, because we happened to start at the beginning of the worst 9-year relative performance of small stocks versus large. Never in the data had small stocks underperformed large stocks by as much as they did in our first 9 years in operation. So we have a new firm, a new concept, and the performance is very disappointing. In that 7.5 years period ending at the end of 1990, I think the S&P compounded at 14% a year, and our small cap fund compounded at 2%.
Oh, that's more than I was remembering. I knew the spread was wide, but that's wild.
That's why. So people ask all the time, and I think that's so important that you have people have fundamental, strong fundamental ideas, strong theory to support them. Because how do you survive in that environment? Well, it's because we go back to the same thing. Well, when you have a stock portfolio, you ought to have stocks of large companies and small. We still believe that. And it turns out this was not a period when that worked out, but we still have the same idea. The, the good news in that was by the end of 1990, we didn't have any competitors flogging small cap stocks. We were alone out there arguing the virtues of selling, of investing in small cap stocks. And you just have to prepare whatever premium you're looking at, and whether you're talking about the equity premium or the term premium or whatever premium, they're going to be a very big variation in results. That's just the name of that's just what it is. So, and we delivered what small caps, in fact, maybe even a little better than you would have expected given the performance of the indices. So that's the story.
We're going to take a break and come back after a few moments. I will reintroduce you for those who tuning in only for the second half. And
Okay.
we can move on to the last 35 years.
For more information, please visit rpc.cfainstitute.org/research-foundation.